Anand Shah of PMS and AIF Investments with ICICI Prudential AMC joins us now. Anand, good morning. Thank you for joining us. Uh, let's understand with a very basic question. Why are markets going up the way they are? Nothing has changed in last 2 or 3 weeks, but the price action in mid and small cap stocks has been absolutely stunning.
Hi, good morning, Nikunj, and thanks for having me. So again, look, liquidity in the domestic markets have been great. To top it up, the earnings over the last 3-4 years have also been very strong. So that's also sort of supporting the price movement to some extent. What I don't know what's changed in the last 2 to 3 weeks, but to be very honest, nothing has changed. And to that extent, we have a continuity of policy. That's what is expected. We had continuity of, in terms of the people heading various ministries. And to that extent, I think it's more of the same. You have a strong domestic liquidity and strong earnings growth rate. And that's pushing the limits, pushing the prices up to some levels where now the risk rewards have sort of turned much less favorable than what they were in the past.
But Anand, is there a case for any sort of dip or consolidation? I mean, I'm not even using the word correction because it seems very far-fetched right now. But what will lead to a shake-off in the market then?
Yeah, so I think, yes, you're right. And many of the market participants have forgotten the word correction. But let's be sure that market by nature will correct. In the past 34 years of data that we have, markets have corrected more than 20% for more than 30 times. It's corrected more than 10% for 107 times. So 10% and 20% correction, 20% rarely, but 10% is more normal. And to that extent, one should not forget that market will sort of correct. Now coming to, we all debate what are the risks in the market, what can go wrong in the markets. The fact of the matter is the large corrections in market don't come because of the known risks. Generally, they come from the unknown risks. All the known risks sort of gets priced in also. So if you see, last 4 years, while it looks like the market is doing well, it's not the all pockets of market are doing. So there are sectors where there are challenges of growth. Consumer-facing businesses are not growing. They have consolidated over the last 3 years. They've not gone down, but they've not gone up also. Similarly, IT sector, again, there are challenges of growth, and to that extent, that sector has not performed. The same breath, the manufacturing allied businesses like cap goods, industrial products, construction, they did very badly prior to 2020. There we are seeing some revival, and that all shows up in banks. So you have set of banks which also paid the price for NPAs in manufacturing sector and manufacturing allied sector, including power. Now they are seeing the benefits, they're seeing the recovery, so they're also reviewing. So I think the known risks and the known opportunities are sort of priced. For the market to correct sharply, I think it will be more unknown risk, something which has not been factored. That would play out.
Anand, I want to go back. I mean, I was just looking at your portfolio. You have a very good, portion of your portfolio in machinery and allied machinery. So, machinery and construction, a data point has, come up that India's industrial, which includes machinery and construction, has touched almost 425 billion in market cap, surpassing Germany and Korea. But the aggregate sales and EBITDA are about a third of these. So if you compare ourselves now that we are being compared to top 5 global markets, within them, are there sectors which are getting overvalued or their overvalue is justified because of superior earnings growth?
No, indeed. Again, I'm repeating. Look, we all look at past returns and expect those returns to sustain. Unfortunately, it's the other way around. Whenever the past returns are bad, one can expect better returns in the future. Especially when the past returns are so good, the expectations from the future should be muted or should come down drastically. In the same breath, the risks actually go up. So there's no denying that while the earnings growth has been very strong in many of the pockets where stocks have done very well, like defense and capital goods, where the order books are growing nicely. Margin expansion given the soft commodity prices and better pricing power. So there are factors to believe that the earnings growth rate in these sectors would be sharper and better in coming years, but a lot of that is priced. So I think market is not simple today as we speak. It remains complicated. You have within the sectors also there are stocks which you want to own and stocks which you don't want to own. Within the markets, you want to own certain sectors and not own. Coming to your point on manufacturing, I think manufacturing area is something which is not done well in India for various reasons, and that's been the focus area. This further gets benefited as people defocuses from China. China itself has its own challenges of labor availability and decarbonizing the manufacturing there. But otherwise also the geopolitical reasons, people are looking at alternative to China. Both these factors make sure that even if you're a good company, your chances of doing well is much better than what it was prior to 2020.
How would you approach staples, durables, given that we are in for a good monsoon, given that inflation is topping out? Is there trade coming back in that end of the market?
So again, staples, particularly all the consumer businesses were really frothy back in 2020. So because nothing else was doing well, and they were very, very richly priced to the point that somebody started saying that the valuations don't matter in these stocks. But to be very honest, over the last 3 years, 4 years, after the consolidation, while the earnings have inched up, they have not done great, but they've inched up. The froth is much lesser today in those segments of the market than what it was in 2020. Nevertheless, the challenges remain. They still remain expensive relative to the market. The growth is still muted relative to the market. And everybody is hoping, because they've done very well prior to 2020 and it's a large part of people's portfolio, they're hoping that they will start doing well. Coming to what can help the consumption as a whole, and that's where we are of the big belief as a fund house that the way forward is urbanization. Today we have 65% of population living in rural India, 35% of people in urban India. It's very difficult to improve per capita income and consumption for somebody who still remains in the rural part, because to take factories, to take jobs to the rural India will be very difficult. It will be easier to bring jobs to the urban India. And to that extent, the focus of the government should be and is today on building massive urban infrastructure, providing housing in the urban areas, and helping manufacturing to add capacities in all parts of the country, but closer to the urban areas where then the migration can happen from rural India to urban. I think consumption for us still is away. We're still focused on manufacturing allied businesses, where clearly we are seeing focus of government as well as the tailwinds from the macro geopolitics.
What's the strategy right now? Don't do anything, just ride the wave, and definitely don't put fresh money to work?
I think, I repeat, the risk rewards, the expectations have to really prune down. You had great 4 years. People have gotten used to making a lot of money very quickly. I think that's not sustainable. So the expectations, people need to increase the investment horizon, because equity as an asset class will remain part of the portfolio. So one will have to look at their own asset allocation. And to that extent, one needs to be careful. If you have too much of equity in your portfolio, you will have to reduce that, prune that slowly. Within the elements, you'll also look back and saying, what is there in my portfolio? I have a portfolio of companies which are not growing earnings, but they're richly priced. You will have to shift it to the right segments of the market. So some of the study, some of the reallocation is required both within the asset class and between the asset classes.
We've all seen how the oil and gas pack, the refinery part has got re-rated. But upstream, actually, that was the neglected part. Now, a lot of policy nudge coming in for their oil and gas volumes need to be hiked, all of that. Would you look at upstream as well?
So we look at all parts. We have a team of analysts who look at all aspects of the economy and all parts of the economy. I agree. We are one of the large importers of energy, including oil, gas, and coal, and we have reserves. And to that extent, there is a strong need to invest and extract that today, rather than keeping it under the ground. And to that extent, yes, we continuously look at upstream, downstream, refining, transportation of gas.
So if you have to say where is value in this market, what is that one pocket? Chota pocket, but I'm sure there is value somewhere in the market.
No, I'm sure, and we are more or less fully invested. That tells you that we are able to find ideas, that we still remain convinced on pockets of the market. One of the areas where we have been very, very clearly overweight is banks. Banks remain still reasonably priced. They're large banks. The industry is consolidating. The pricing power is improving, and the risks are very, very low today at this point. Generally, the risks in the bank increases once they start lending rapidly. That's not yet started. So we will have some years before the risks start emerging in a big way. I mean, obviously there would be some NPAs every now and then, but the large risks on the banks will only post they lend aggressively, and all credit to the regulator. We are very proactive in addressing any risks that are there. The other area is manufacturing. Banks are big beneficiary also as manufacturing recovers. The past NPAs, you're getting buyers for them, and you're also, getting a recovery is much more than what otherwise you would have got. Manufacturing allied. So these are the areas: bank, manufacturing, and manufacturing allied, which includes power, the entire T&D space, generation, and to some extent logistics and capcos and industrial.
Okay, great to have you then on the show, Anand. Thank you so much for taking the time out and speaking with us.
If you like this video, then like, share and subscribe to ET Now.